down 600 Monday. All right, up 1,100 points yesterday. Futures indicating down 400. You thought you were watching the stock market. In reality, it's Six Flags. What do you make of these moves?
I'd say if I was an individual investor, it doesn't make me confident about being in the stock market with these sort of wild swings that may or may not be attached to any fundamentals, given that the economy still kind of looks okay. Consumers strong, wages are up, cheap gasoline. Consumers, 2/3 of the economy, that's looking good. And if I was the average investor looking at that, I'd say those guys or those computerized guys, the algorithms are crazy. Maybe I should be in cash, or I would find it very unsettling.
Yeah, we like it. Listen, most people own stocks, right? So it's good when stocks go up because that's how most people
we
retire.
like them when they go up. That's great.
But that's just because most people don't short stocks. I mean, we buy things and we hope they go up in value, our home, whatever it is, right? But here's the thing. 1,100-point gain looks nice, and everybody wants that gain. But to your point, you're thinking, wow, wild swings either way just don't seem like the hallmark of a healthy market.
No, listen, if you think that, ultimately, Wall Street is over the longer term it's efficient, it's rational, it's about distributing capital, all that good stuff. And then you see what's going on. Again, there was that great Wall Street Journal article looking at the algorithm. So maybe you think, gee, this is like artificial intelligence moving things. This is very different than the sort of, traditional kind of Warren Buffett approach to investing.
We need to put the capital in capitalism. That's the idea of the stock market, right? Is that I'm going to take a sliver of the American dream. I like this company. They make ice cream or jet engines or whatever it is I like. I will take a slice of that, and hopefully I will get rich with them. That's the idea. Companies need our money. We need their gains. Everybody wins. This could be like this kind of stuff where people are getting frustrated with the market and these massive swings. Oh, bad for capitalism, is it not?
It is bad for capitalism because, again, you'd like to think that somehow what goes on in these financial markets, it's not just all algorithms and trading. That sure, maybe on a day-to-day basis, over the long term, it is attached to the economy. And again, we had Mnuchin talking to the CEOs, getting their take on liquidity and do they have enough capital and all that. The same banks that they represent. Nobody's forecasting a recession or anything even close. A slowdown, sure. But the only person I know really forecasting a recession is Larry Summers. He gets that right. Huge feather in his cap, I guess. But, Goldman Sachs, JP Morgan, a slowdown, but really sort of back to the economy we had, a 2% economy. It's not a 3% economy, but it's not a recession.
Let's take the other side, because I get it. The bears out there saying we're going to slow down. We could only have a 2%. By the way, a couple of years ago, a 2% economy would have sounded pretty good. We're chugging along at what, 1.5?
That's potential.
All of a sudden now,
that's potential.
2%. A number is a number. 2%. A B minus or a B plus is a B plus or B minus. Can't be bad one way and good the other way. I guess unless you think the trend is just past 2% to 1% to recession. Do you?
No, listen. Obviously, we can grow at 2%. We grew at 2% for a long time. We can continue to grow unless we get higher productivity growth. That's one point of this tax cut. Remember, the point of the tax cut isn't supposed to juice the economy. It's to increase investment and then eventually productivity. That really hasn't happened. We've seen a little bit of an uptick. If we get faster productivity growth, fine, we'll get 3% growth. If not, we are a 2% economy over the past few years, and we should be a 2% economy going forward. You shouldn't freak out about that.
We had a big interview with Scott Minerd on the Halftime Report yesterday, global CIO of Guggenheim, very smart guy, and he said basically that, listen, I like Jerome Powell. He's a smart guy, but he made some wording mistakes. And you look at sort of, what Mnuchin has done. You referenced that email. I called the banks and everything's fine. Well, nobody asked if everything was fine. We thought everything was fine. The president, has been sending out some tweets. And, you get the snarks out there on social media who said yesterday was so good because everybody kept quiet. Is there a lesson here? Don't just stand there. Do something. There is a massive lesson there that investors don't like the crazy. They don't like things that seem like people are winging it. There's a process. We have a financial oversight stability council that Mnuchin could have called them. He could have had a meeting. They had one in October. There's a process. I think it's also this sort of lack of process where it looks like the White House, particularly the president, are just kind of not following the rules, and it makes it very unpredictable. We've got a lot of things unpredictable right now. I think people would like to know that there's an actual process for how decisions are being made, not just with the shutdown, but even with China, which I think ultimately is a much bigger issue.